Good afternoon. Welcome to today's second session of the CFR's virtual Robert B. Menschel Economic Symposium. Today's event will be on the record. To ask a question during the Q&A period, please click on the raise hand icon on your Zoom window. When you're called on to speak, please accept the unmute now button. Then proceed with your name, affiliation, and question. Your video will remain off, but your microphone will be unmuted. To view the booklet for the symposium, along with the roster of CFR members registered to attend, please click on the link in your Zoom chat box. Thank you, and Catherine, over to you.
Great, thanks so much. Welcome everyone to the second session of the Robert E. Menschel Symposium, Looking Ahead, Forecasting the Global Economic Climate. This symposium is made possible through the generous support of Robert B. Menschel. Since his passing in 2022, the symposium continues in his honor and memory. The audience today consists of council members and guests around the country who are joining us online via Zoom. As you just heard, this is all on the record. My name is Catherine Rampell. I am an anchor at MS Now, formerly known as MSNBC. I co-host a weekend show called The Weekend Prime Time, and I'm also the economics editor at The Bulwark. I'm presiding over today's discussion, and I'm delighted to do so because we have a wonderful panel, beginning with Jared Bernstein, who was, until recently, the chair of the Council of Economic Advisors under President Joe Biden. He is now a fellow at CEPR and at the Center for American Progress. We also have Peter Fisher, who is at MIT's Sloan School of Management. Formerly, he was Undersecretary for Domestic Finance at the U.S. Department of Treasury from 2001 to 2003. He is also a CFR member. And Carmen Reinhart, who is a professor at Harvard Kennedy School and co-author of This Time is Different, 8 Centuries of Financial Folly, which is somewhere on the shelf behind me. She is also former deputy director at the IMF and a current CFR member. So thank you again to our panel for this wonderful opportunity. This panel today is going to be talking about speculative bubbles and how policymakers could or should address them. So I thought we would start out by having each of our panelists give a brief overview of how they are thinking about the risks of a market bubble right now. Peter, can you kick us off?
Sure. Thank you. What fun to be here. Let me draw a couple distinctions. First, I think it's worth saying we've got 3 things going on. We have an epic investment boom. And an investment boom is different from a bubble. And then we have bubbles, which are valuation problems. We can have a credit bubble and we can have an equity bubble. And maybe we've got all 3 of those going on. The scale of the investment boom came home to me recently when I met a relation by marriage who closed his own business to go to work for a friend who makes a small component part that goes into cooling systems for computers. And this company is scaling up from producing 10,000 units a year to producing 100,000 units a month. That's a 12,000% increase. Now, that kind of investment boom creates malinvestment problems all by itself, whether we have a valuation problem or not. Quality control is going to be a huge problem. And so whether it all turn out remains an open question. Secondly, we will invest more in AI than in other things in our society. We'll have a maldistribution of investment. We'll miss some things we'd like to have more of that we won't have in the future. That's the investment boom side of it. The bubble side of it is a credit bubble, which involves lending money to people who can't pay you back. And it's actually easier to identify a credit bubble than an equity bubble, but the consequences are much worse. And I think we see early signs of a credit bubble. And then equity bubble is a valuation problem, and we can maybe get into that as we unravel. Let me just have framing it that way.
Carmen, can you follow up, please?
Well, that was very helpful definitions that Peter laid out. I'd like to say that from a historical standpoint, equity bubbles are very easy to pinpoint in the rearview mirror. In real time, getting the timing is elusive. I teach a financial crisis course at Harvard, and we study recurring symptoms. So you can say a lot about, are the symptoms there? And I agree with Peter that many of them are. I will add a couple that to his list. But the timing of the burst is elusive. Having said that, what are the symptoms? Well, Kindleberger, a big hero of mine, is one that laid out very importantly also the state of global financial conditions. Global financial conditions are quite accommodative. Where do you see this? Well, we have real interest rates that, notwithstanding the rate hikes, are well below historic norms. We have very tight credit spreads uh, between the high yield and junk or lower graded bonds. You don't see that during periods of monetary tightness globally. We have very elevated PE ratios, and very troubling, we have an increasing share of the activity in the equity market being funded by debt. Debt has risen fairly sharply. This is the credit bubble that Peter alluded to. And all those symptoms lead me to believe, yes, we have a bubble. Have I any idea on the timing of when the bubble will burst? As I said earlier, I don't think so. However, what I would like to highlight is that this is not the same bubble we had in the run-up to 2008 global financial crisis. We should not confuse equity bubbles with housing bubbles. None of them bring about good things, but they are indeed different animals. Let me stop here.
Actually, do you want to follow up on what you mean by that they're different animals?
The housing price hits at the core of the banking sector. It hits at the household sector in a way that the investment boom that we are going through does not. And therefore, the consequences, which we will address at
Yeah,
some point, are distinct.
sure. Great. All right, Jared, up to you.
Thank you. And thanks to all who made this possible today. In October of last year, Ryan Cummings and I wrote about the risks to financial markets from a potential AI bubble. And we stressed the gap between investment and probability, as you've heard already from Peter and Carmen. But this is core to bubble formation, as bubbles occur when the level of investment in an asset becomes persistently detached from the amount of profit that asset could plausibly generate within a time frame that matches investors' expectations and patience. Well, when you're talking about expectations and patience, you're introducing some fuzziness, which is why Carmen correctly pointed out that you can't really time these things. But if you'd put up my first figure, I'll give you a picture of what I'm talking about. This shows hyperscaler CAPEX with 4 of capital spending, capital expenditure, with 4 of the Mag 7 there. And what you see is the 26 CapEx. This is forecast. This is what we expect them to invest on top of what they've already invested relative to an estimation of their AI revenue. And I specify AI because obviously Google and Meta and all 4 of those have much more revenues than you see there from their other components. But you see there that gap between investment and revenue. And I show that as a picture of what we're talking about when we worry about the bubbly implications of the gap between investment and expected profitability. Now, look, that's 26 and 25 revenues. So no investor expects these kinds of returns to appear right away. So the question is, how patient might investors be? Well, that's the other point I wanted to make in my opening comments, which is there's some evidence that patience is fraying and leading tech firms are expected to significantly invest this year. Google's expected to invest from to basically double their investment to the bar you just saw. Amazon expected to kick up their investment from around 130 billion to around 200. But whereas the 2025 investor, speaking broadly, was pretty enthused about that kind of capex, the 26 investor appears to be reacting much less positively to more capex in AI, a signal that they want the firms to start showing more prospective returns. Microsoft's a good example. It's down 17% from its Q4 earnings announcement, in large part due to its failure to increase revenue from AI. Amazon had a similar double-digit percentage decline after they announced they would spend 200 billion this year on capex. Here's a great quote from Reuters that I think summarizes this sentiment. Tech earnings over the past few days have shown Wall Street has a clear message for tech firms. Soaring AI spending can continue only if companies show commensurate operational or financial returns. Now, I don't want to overhype on this, and I don't think the implosion of this potential bubble is imminent, but I do think patience is fraying. Second point, which I can be quick on because Carmen touched on it, if you could show my second slide, there really is a lot more debt now being taken on. In fact, tech companies are taking on record debt for AI, and you see the almost asymptotic increase there at the end of the figure. Now, when Ryan and I wrote about this earlier on, we actually worried less about the macroeconomic impacts, which I know we'll get into, of a tech bubble implosion, because we just didn't see the debt as embedded in the credit side of the economy in a way that looked as systemically risky to us as the housing bubble, and you heard Carmen echo similar points. I'm less sure that's the case now than I was a few months ago. So that's another concern of mine. Let me stop with two quotes that I think are really kind of telling about this bubble situation. The first is a quote you're probably familiar with from Chuck Prince, who was a former CEO of Citigroup, who said back in July 2007 regarding their investment in subprime mortgages, quote, "As long as the music is playing, you got to get up and dance." And that was a few months before the financial crisis. Here's a quote from a senior software analyst on Amazon. Amazon has to invest at these levels just to stay in the race. The sentiment of those two quotes is uncomfortably close to me. I'll stop there. Thank you.
Thanks so much for those opening remarks. Carmen, I would love to hear your thoughts on the macro consequences of everything that we're talking about. You sort of alluded to the fact that there are more systemic problems if there is a speculative bubble in housing. But what about if we're talking about relating to AI investment? What are the macroeconomic consequences and what are the systemic or potentially knock-on effects?
Well, there is the expected effects of AI, and then there is the potentially actual effects of AI. If you take a long historical view from the late 1700s and look at trend GDP in the US, you can measure trend different ways. You get the same picture. We had the railroads, we had telegraph, we had the internet, we've had enormous number of innovations that were all touted to this time is different. We're going to get a surge. We're definitely going to see the output effects. Those effects are not there. The actual deviations of GDP from that trend, the long secular trend, very small, except for the Great Depression. And so there is going to be, this is a winner takes all. There's going to be a lot of overinvestment. You couple overinvestment and Jared's graphs, I think, also highlighted that point, as did Peter's remarks. You couple overinvestment with debt. That's not a good combination. So I think that there will be a fallout, a corporate fallout, and overinvestment, in the sort of the old saying, well, if you have a boom and you have a consumption boom, It's a problem. If you have an investment boom, no, that was future growth. But if the investment turns out to be less than productive and outright misallocated, as Peter alluded to, um, you might as well have consumed it. So the impacts are negative. I don't think they hit at the core of the financial center the way the 2008, 2009 housing boom crisis, uh, uh, not just in the US, but elsewhere. Uh, but you know, it raises always the risk of a recession, and corrections are painful this time. I think it will be concentrated in the corporate side, but effects do filter to households. The allocation of wealth has shifted. So I'm not saying that households will be untouched. And there are, of course, also employment consequences associated. So bursting bubbles are not good news um, for the economy. One way or another, some are more damaging than others. Um, but all those, the risks are on the downside.
Peter, I'm wondering if you could follow up on that a little bit. You and I had, or during our prep call anyway, you had been talking about what signs you would look for if in the data, if in fact we are at risk of a speculative bubble, the bursting of a speculative bubble, and some of the fallout that Carmen just laid out. And correct me if I'm wrong, but my recollection is that you are a little dubious that we actually have useful data right now to help us answer some of these questions.
Well, my point was really a very simple one, and you're right. Numbers like domestic private investment are going to get revised over and over again when you have a boom of the scale. And so when we look at the data, I'm not meaning, I don't think they're being bad about collecting the data. I'm not worried about political interference. Those are different subjects. I just mean when you do something at this scale that we've all been talking about, this epic investment boom, we're going to find we end up revising the data over and over again because the collectors are overwhelmed. And I just think that's something we all should wake up to. Now, I was also, though, alluding to something maybe we'll move into, which is the Federal Reserve is really driven a great deal by the Phillips curve, trading off the trade-off between unemployment and inflation. And I think those numbers themselves have some problems now with the labor market and changes in the pattern of consumption moving up into the top of the income distribution. But so those numbers themselves are problematic to me. What their meaning is, not how they're collected. But that trade-off isn't going to be helpful for addressing the sort of problems with real rates Carmen was referring to. That is, the Phillips curve itself is not an adequate guide to everything people expect of monetary policy when financial conditions become this easy. So it's easy for the Fed to claim they just do the Phillips curve trade-off. Actually, we all know they also care about financial stability. That was the mix of things I was pointing to.
Sure. Jared, this is a somewhat nice transition to something that I did want to ask you about, which is that we're talking about, in many ways, what might be an overheated economy, or at least the possibility for parts of the economy to be overheated, that there's a lot of speculative investment, a lot of cash out, maybe some bad money chasing after good. But if you look at the actual, if you look at the softer metrics for the economy, consumer sentiment, for example, you don't see much evidence that people believe that the economy is running hot, or that there's that much frothiness in the economy. I guess I'm asking, how do you reconcile the fact that we, in some parts of the economy, at the very least, we do see this sort of euphoric almost level of investment? How do you reconcile that with the fact that regular people out there seem to hate what is going on in the economy? Is that just rank partisanship? Is it that we're talking about different parts of the economy, different people? How do you reconcile those things?
I think it's pretty different from everything we're talking about, and I'll explain why in a second. Let me just say two things, though. One is that I wouldn't characterize the current macroeconomy as overheated, just to be clear. I see GDP growing, around trend, maybe a little bit above. Certainly, the job market in its low hire, low fire mode is not overheated. And were it not for the tariffs, I think inflation would be falling back down closer to target than it is. So I don't see evidence of overheating. Um, in terms of the recessionary, I just wanted to add on to things that Peter and Carmen said, is that no, I don't think anyone mentioned the wealth effect. And I think that's probably my biggest macroeconomic concern about a bursting bubble's impact on at least near-term economic growth in ways that could put upward pressure on unemployment and have the impact Carmen was talking about, where you see it doesn't just hurt corporate investors, but it hurts households because when the unemployment rate goes up, it's the bottom half that gets hit most. And I do think that our pretty strong consumption right now is partially driven on real wage gains, but partially driven on the wealth effect, which is that for every dollar of equity appreciation, holders of those assets spend another 2 cents. And that's been a real source of growth. People talk about the K-shaped economy. I think that's partly what they're thinking of. So very quickly, so what do I think it is, this disconnect between a pretty solid macroeconomy and how people feel about it? I think it has a ton to do with the level of prices, not even inflation, which, at least before tariffs was kind of coming back down. It's the fact that people got shocked by a really dramatic increase in the level of the things they bought: groceries, health insurance, gas at the time, which peaked at over $5, retail gas. And while those prices have been climbing less slowly, they haven't come down. And I've done a great deal of work on this, which I won't bore you with right now, but you can explain a lot of the gap between how people say they feel in the overall economy by just factoring in this price level disconcertedness.
Carmen, I want to talk a little bit about how you think about the risks to the dollar right now, whether related to some of this market frothiness that we're talking about or risks to rule of law. How do you see those risks shaping up in the next year or several years?
I've been getting that question a lot these days, but I just wanted to add one quick element to what Jared just said. I think part of the discontent that we see in Main Street, it has to do with the labor share of income. Labor share of income has been trending down since World War II, but the downward shift since the global financial crisis is notably sharp. So yeah, GDP is growing, but it isn't going to a lot of the workforce.
Yep.
So let me now turn to the dollar. Um, I think people are conflating secular and cyclical issues here. And so there's two questions. Is the dollar likely to be weaker? Well, that's like forecasting the equity market, right? It's an asset price. But there's a lot of reasons why you could see a weaker dollar. Is the dollar as weak as it's ever been? No, the dollar's, people forget, the dollar has had spectacular crashes in the past without losing its reserve status, which is the secular part. During the breakdown of Bretton Woods, the dollar crashed against the Deutschmark by over 50%. It didn't lose its reserve status. Why do I not think that its reserve status it's fraying, okay? It's fraying, but it is difficult to pivot away from the dollar quickly because there are no alternatives at the moment to compete with the liquidity of dollar assets. The renminbi, big powerhouse, economic powerhouse. China, enormous global footprint, not a convertible currency. As Rudy Dornbush used to say, people like to go to a party if they know that they can leave the party whenever they want. So capital controls are a big impediment there. The euro, the euro is a unified currency, but it is not a unified debt market. It's a very fragmented debt market. So the liquidity, people don't, central banks or private investors don't buy greenbacks. They buy the underlying assets. And the euro remains a very fragmented debt market. So there are not many alternatives. However, I mentioned that things are fraying, and I think the fraying is coming in terms of the geopolitical correct view that the safe haven status is subject to the kinds of risks that we've seen coming particularly from this administration. The erratic policy changes, the use of the dollar as a weapon, which is also not new. So I think there are elements in which the dollar is fraying. However, those that rely on official holdings of the dollar are overstating it. Yes, central banks' holdings of treasury securities peaked around 2015, 2016, but the inflow into other dollar assets, notably the US equity market, and also other assets like corporate bonds and Federal Reserve RPs, has been very significant. So bottom line, I think there is plenty of room for the dollar to weaken. The weakening signaling an end to the dollar era, I think that is premature.
Peter, that is a nice segue. Since Carmen mentioned in passing the erratic policymaking here in the United States, we had a pretty significant Supreme Court decision on Friday that maybe curbed the ability for our current president to do some of that erratic policymaking, or at least put a little bit more guardrails in terms of how quickly tariff rates can change. But of course, the president then put in place additional tariffs. How do you see the tariff landscape affecting the global macro picture in the next year or so?
Let me just take on the U.S. macro outlook.
Fair.
That's too big a question. The way I think of it is that the investment boom we've been talking about means we're getting a lot of business fixed investment in one sector. Admittedly, maybe an important one, but it's massive. Trumpian uncertainty about tariffs, maybe with guardrails, maybe not, weighs on a lot of other investment that might be made in our economy. And the consequences we will feel from that will be eroding our future productivity in other areas. I mean, I completely subscribe to what Carmen said about how hard it is to see productivity accelerate dramatically because of technology, when you look in the long sweep. There may be something there. But we will definitely be suffering, the macro consequences will be suffering from a lack of investment in other parts of the economy because of Trumpian uncertainty. And that's one consequence of the tariffs as well as the inflationary impact.
And Jared, before we go to questions from the audience, I'm curious if you have thoughts on that particular topic.
You mean SCOTUS wax POTUS, that one?
Yep.
I think it's more, I like what both of my co-panelists said. I mean, I think it's more, for me anyway, and I've been tracking this from the beginning and have been quite unsettled by the impact of the tariffs on uncertainty, on geopolitics, but also, as Carmen and I were just talking about, on affordability. Carmen mentioned labor share. I talked about price levels. The absolute worst, most counterproductive policy you could almost think of if so much of the populace is concerned about affordability is making things more expensive, which of course is what sweeping tariffs do. So I think that they're hugely problematic. And I say that as someone who's been critical of trade deficits more than the average economist. Now, to answer your question, I think it was more of a victory for the rule of law than for the economics I just described, for the very reason that the administration has other statutes that are more durable. They somehow, in their infinite wisdom, chose the absolute worst statute to do what they did, and even a sympathetic Supreme Court couldn't back them on it. So that's really where I take that.
Catherine, if I can just jump in
Please.
1 second. Um, you know, I think yes, it was a victory for the rule of law, but the for uncertainty, whack-a-mole. This is whack-a-mole, right? You kill one thing and another one surfaces. We have a new tariff now with promises to search for other tariffs. So this does not alleviate the problem that the U.S. has become a more uncertain economy to invest in, number one. And quickly to conclude, number two, we're suffering also from the effects of like Brexit. In Brexit, the forecast was that the UK economy would collapse if Brexit was passed. It didn't happen immediately. No, it did not. However, the deleterious effects on medium-term outlook, slower growth, higher inflation balance, is certainly playing out, and I think we may have that road ahead of us.
Catherine, let me inject 30 seconds also before we
Sure.
get to the Q&A. Sorry.
Sure.
But I've been wanting to say this because as I've been listening to Carmen and Peter and myself, I've been struck by something. There's a well-developed theory, and I think empirically grounded theory in economics, called the real option value of waiting. And what that theory tells you is that, and again, it's an empirically founded theory, so this really happens, is that in periods of great uncertainty, investors recognize that the value of waiting to see kind of where things land is actually the better part of valor, that kind of caution. And so often when we have this level of uncertainty, we have pretty weak investment. But here, and I think this is another kind of bubbly kind of observation, we have the opposite. High uncertainty and high investment, those two aren't necessarily supposed to accompany each other, but when they do, it can sometimes smell a little bubbly.
I will also point out that the CapEx from AI affiliated companies is partly enabled by the fact that there have been tariff carve-outs for chips and for other inputs related to that investment. So maybe other investment is being held back by tariffs, but that is not. All right. On that note, let's turn it over to audience Q&A. I think we have some questions queued up.
Ladies and gentlemen, as a reminder, to ask a question, please click on the raise hand icon on your Zoom window. When you are called on to speak, please accept the unmute now button and proceed with your name, affiliation, and question. To view the booklet for the symposium, please click on the link in the Zoom chat box. As a reminder, today's discussion is on the record. We'll take the first question from William Kurt Hunter. Looks like we're experiencing some technical difficulties. We'll take the next question from James Stephens.
Hi, folks. Thank you very much. James Stephens with the Stimson Center. I want to thank you all for what has been a really candid and insightful discussion. And I wanted to push for your kind of votes, if you will, on whether or not you believe that some of these inherently inflationary policies have the deliberate effect of increasing prices and weakening the dollar as part of some economic theory on the part of the Trump administration, whether they believe that it is a good policy idea to weaken the dollar internationally and also keep affordability problems high at home. Thank you.
That's a hard thing to vote on. So you're asking about their intention. And I can only judge the intention of members of the administration by what I hear them say. And there, in response to your question, I hear a mixed bag. I hear some voices who say they would like to weaken the dollar and other voices who say they wouldn't. And it reminds me of being in administration and learning that an administration is not one thing. An administration is many things. So it's a hard thing to vote on, but I do hear some of the voices saying that and others denying it.
I'll quickly say I'm very suspicious when I hear high intellectual theories attributed to the Trump administration, just because, sort of like Peter said, they're a very disorganized group of people with lots of different views. Now, I will say that my successor at the Council of Economic Advisors, Stephen Murin, actually wrote a paper before he went in, where he touted the value of a weak dollar to help boost manufacturing. And in fact, the trade deficit this year is almost exactly the same as it was last year, even with the weakening of the dollar, both around -3% of GDP. And our manufacturing sector is really struggling. So if that was the theory, it hasn't worked thus far.
Very quickly, I don't think, as a goal, I don't think this is interpretation. Any administration would want a higher cost of living because that costs voters. I do think that, the statements of a weaker dollar are motivated by the idea that simply weakening the dollar would close the trade balance. In theory, it's supposed to happen that way, but other factors are at play. For example, the surge in imports that we have seen, notwithstanding a weaker dollar, has been concentrated in AI imports from Taiwan, notably. Desirable weaker dollar. Well, let me say it's a double-edged sword. It also may make Treasury securities less attractive. And don't forget, we have a ballooning budget deficit and a debt path that the CBO already has been sending out serious warnings. So the weakening of the dollar may be one of those factors that is unraveling at the fringes. But I agree that the messages have been very mixed.
All right, let's go on to the next question, please.
We'll take the next question from Antoine van Echtmel.
Thank you very much. My question is, the president has touted a lot of investment as a result of these trade negotiations related to the tariffs. Now that has changed. Will we see much of that investment?
I'll start. We hadn't seen all that much to start with. So a lot of the agreements that were made were much more informal than the kind of trade agreements I worked on when I was in government. Peter maybe as well. And so they were very rarely written down anywhere where you go look at them. And one of the things that happened quite quickly, this happened with the Japan agreement right away, for example, is that, as well with the EU, is that the signatories on both sides were making comments to the media that showed that they didn't really quite agree upon what the other side was saying. So they couldn't really agree on what they thought they had shaken hands on. So I think that the investment coming out of the trade deals is a suspect all along, and even more so now, as your question suggests. However, there's been pretty healthy foreign direct investment just because of the economic dynamics that we've been talking about today, and the inward capital flows, which, by the way, is another reason why the trade deficit has not changed very much, because that's the capital account side of the equation. So I actually believe President Trump when he says, I like FDI, and we've seen a fair bit of that. We had a lot under Biden as well.
I don't have anything to add. I think Jared's comment's a good one.
Carmen?
Well, I really we'll pass. I will.
All right, next question then.
We'll take the next question from Bob Hormats. Hi, Bob. Please accept the unmute now prompt.
Okay, can you hear me now?
Yes.
I'd like to broaden this a little bit to the international focus. The point was made that debt is a significant risk in certain circumstances, particularly when you're using it to buy equity. My concern is about a global financial crisis. Not only does the US have a great deal of debt, and you don't know when the red line is going to be crossed, do we have that as a generic problem in a lot of other countries that could mean when this debt situation becomes more troublesome, you have other countries that suffer from lack of confidence in their ability to repay, and that leads to a downward spiraling effect. In other words, it's not just one country, us. Are there a number of countries that would be in a downward spiral if the American debt situation or any other big country's debt situation became precarious?
Carmen, that seems like a good question
Yeah.
for you.
No, the U.S. is not alone. Of course, Japan still holds the record on the highest debt among the advanced economies. In Europe, it's a mixed bag. France has lost its credit rating recently because of a rising debt problem. And of course, Italy has been in the background for some time. But in the context of Europe, debts are poised to rise in part because of the need for military spending, as well as the secular factors of an aging population and so on. So yes, if you aggregate across advanced economy, debt levels are close to to World War II peaks. Now, does that mean an imminent financial crisis? I don't think so. However, let me say something that has changed dramatically in the last couple of years, which is higher real interest rates have returned, still low by historic standards, but higher than the low for long, low forever. In the low for long, low forever, the philosophy was you could get indebted without really risks. Growth would be higher than real interest rates. You would have no problem servicing the debt. That is proving to be a challenge, including in Japan, which was an extreme case of very deeply negative real and nominal interest rates. So what am I saying? I'm saying that debt has more teeth now as interest rates have normalized after the spike in global inflation. And the immediate consequences is not necessarily to expect a debt crisis around the globe, around the corner. Advanced economies have, especially the US, have a long rope with which to hang themselves, but they have a long rope. But I think over the medium term, the impacts on economic growth and the impacts on households as more of government resources are devoted to debt servicing are a weight on both growth and potentially, in the most extreme cases, economic financial stability.
Do either of the others, Jared or Peter, do you want to weigh in? Okay. I think we are out of audience questions at this point, but please feel free to raise your hands and let us know if you have other questions. In the meantime, I'm happy to go through my remaining questions, one of which is, if in fact there is a speculative bubble of some kind regarding AI, which it sounds like the three of you are mostly in agreement on, what does that mean policymakers should actually do about it, if anything?
Well, let me jump in. I mean, I think that there are fiscal policymakers and financial regulators. The easier one is the financial regulators. And I think it was alluded to by several of us one way or another earlier, that the banking sector is probably exposed indirectly to the AI, even though we can see it in private credit. There's bound to be backstop lines of credit and the other things the banking system is always providing to financial intermediaries and credit underwriters. And I think the lesson of the SVB Bank is the regulators should not be bashful. So SVB was insolvent a year before there was a run, and the regulators were very slow, and by the Fed's own study. So in this case, we're looking at credit problems and whether we would see valuation difficulties in credit. And the regulators have to, again, not be bashful, is my advice. They need to lean in and not be caught being too slow. The fiscal policymakers, I'll just say, I wish they'd be doing something different, but they're not. The big beautiful bill is giving tax breaks to people on the very tippy top of the income distribution, and then we're raising health insurance premiums on the people in the middle and the bottom of the distribution. So we're accelerating income inequality, which is not a great place to be. It's also not a great place to try to engage in fiscal consolidation or austerity. So they're very difficult choices. And I think that's something we should all be aware of, that all these choices get hard for the fiscal policymakers.
Jared, yeah, we have more questions in the queue, but you're welcome to answer this one if you'd like.
Just very quickly, I think Peter's right to kick off with regulation and supervision. The problem with regulation and supervision is often it is modeled after the last crisis. And here the players have changed. So I think aggressive, more aggressive regulation is warranted. I think also it complicates life for the Federal Reserve. A Federal Reserve does not have as a mandate asset prices are not part of its dual mandate, but financial stability is, of course, a concern. So I think, monetary policy needs to avoid feeding the beast. And lastly, I neglected to mention, I certainly had intended to, that I listed the symptoms of a bubble and go no further than, reading some of the remarks on what AI is expected to deliver. To realize that, the this time is syndrome is alive and well. That let me stop here for other questions.
I'll quickly say that I agree with what my colleagues have said, although, I certainly wouldn't want the Fed to raise rates into a potential bubble, in part because you don't want to punish regular folks for the excesses of the investor class. But I think one of the important things is to hope for the best and plan for the worst. And planning for the worst in these cases means making sure your safety net is in good shape. And it's actually been kind of tattered by the big, beautiful bill. So that's very problematic. I mean, the least you'd want to do is get your unemployment insurance and system ready to rock if needed, because a bubble implosion had negative macro impacts.
All right, let's move on to another audience question, please.
We'll take the next question from Juan Ocampo.
Hi there, Juan Ocampo at Lorenz. Since you have mentioned several times about the massive AI investment, which I think the Wall Street Journal had an interesting analysis that put into context that was adjusted for the size of the U.S. economy, slightly larger than the build out of the railroad net in the United States in the mid-19th century. So that's truly massive. If Do you think that the actual driver of this is an investment and return question in the traditional sense, or is it more um, of a game theory kind of problem, the way that John von Neumann might have phrased it? In other words, that of all the tech giants, they can't afford to fall behind their peer. And that's why they're kind of stampeding this way. And you can also think about the same kind of language between ourselves and China, that we cannot afford to to fall behind. In that context, which can unhinge itself from any expected returns, I would argue. If that's the case, does that lead us to think about the kinds of policy measures that you've talked about, of maybe releasing the steam on this level of investment and the inherent risk, to think about it differently, if it is in fact viewed and treated as a game theory kind of problem by those who are making the investment decisions? Thank you.
Well, I think that's a great question, and I'm very sympathetic to it. I think the railroad metaphor is a good one, because it was a massive business fixed investment. And then you had to recoup the investment for earnings through pricing from variable revenues that came from people using the railroads. And so I do think a lot of the railroad investment was game theory, people wanting to get to Chicago first and building redundant rail lines, is my reading of history. The interesting thing is we had the railroad booms and busts multiple times in the 19th century, and we had no central bank. So we weren't able, there was no modulation of monetary conditions by an authority to try to calm the different railroad frenzies of the 1840s and 70s and 80s and 90s. And so it's an interesting thought experiment to try to compare it. I just want to say, with sympathy to what Jared said, is it's not obvious that higher rates is the right thing for the macro economy. And that's just the conundrum the Fed faces now, is this corner of the economy with AI, clearly, as Carmen earlier said, has very easy financial conditions into which, as at the Petri dish in which it's operating. So I like your metaphor of the game theory.
Juan, I also thought your question was really interesting and well framed. I would only add the following. Carmen will know this better than me, so if I'm wrong, Carmen, you'll correct me. We've always had bubbles, and I kind of suspect we always will. And I'm not really sure what can or should be done to prevent them. And in fact, there are ways in which bubbles are helpful in terms of generating a higher investment equilibrium, kind of shocking the economy onto a higher equilibrium path than would otherwise occur. And in the case of railroads, internet, and probably AI, and I feel like the probability is pretty high here, they've all had really important positive productivity returns. So even while all of us are angsting about potential bubbles, I don't think any of us would claim that the ultimate impact of the investment would be productive. We're trying to spend a lot of thinking here, noodling about ways to diminish the downsides, but it is kind of a golden goose problem.
Do you want to take a whack at it?
Sure. I welcomed the references to the railroads, and just to remind everyone, there were a huge number of bond defaults, which were the conclusion to the railroad manias. Look, the situation that you're pointing out, in which you have competitors. I have to invest because I have to invest more than the next competitor, because it's winner takes all. And if I invest more, I'm going to win. That's not new. Read about the East India companies, the Dutch and the British, building armies to fight each other. That also required quite a bit of investment. It is part of the dimension of a number of historic bubbles, including the South Sea bubble. So policy-wise, I want to reiterate, that I do think When I mentioned also the Fed, immediately everyone thought I was just talking about rates, and I am, but not necessarily meaning that a rate hike is called for in the near term. But the Fed was and is responsible for regulation, and some of what happened in Silicon Valley, has highlighted that it can fall behind. So there's an important role to play there for policy in a way that, as has already been mentioned by Peter, we did not see that in the bubbles of the 19th century.
All right, let's try to squeeze in maybe one or two more questions. Let's go to the next question, please.
We'll take the next question from Ralston Deffenbaugh.
Thanks very much for this panel. The current administration has seen an enormous amount of corruption, and they've also reduced dramatically the number of people who do securities regulation or financial regulation, not to speak of public integrity regulation. And I wonder what impact that will have on the economy if it seems that our system is not as honest as it was.
Well, when I was at the World Bank, of course, one of the big cross-country preoccupations is with things like rule of law, transparency, accountability, and its role in attracting foreign investment and in promoting growth, among other things. So you apply those metrics to the U.S. and a deterioration in any and all of these metrics is likely to translate other things equal, right? But other things have not been equal because one of the reasons we have been also such a magnet is our unique position in the AI world. But let me stop here.
Peter, Jared, you want to weigh in? Oh, Jared, I think we may have lost. Oh, there you are.
Yeah, no, I was having a camera problem. Peter, go ahead.
I share the concern about the loss of public goods from appropriate levels of supervision. That what we can always argue about the amount of securities regulators to have, more or less, but I guess I'm just going to reflect. I thought an interesting comment of Andrew Ross Sorkins was looking back at 1929 that initially a lot of people wrote to their diaries and blaming themselves. It was after several years went by, they started blaming others. And it's just interesting to reflect on how we will feel when there's less supervision. I share your worry.
I'll just add that, of course, I share your worry. I don't see how anyone who's paying attention couldn't share this worry. One of the things I look for is for institutional pushback on the kinds of corruption you're talking about. And it's one reason I was glad to see the Supreme Court come down as they did on IEEPA. But that's one out of many decisions where, the court has, at least in my view, supported this unitary presidency in a way that is feeding some of the problems you mentioned, and the checks and balances, which Gorsuch actually wrote pretty eloquently about, the checks and balances that we need in our deliberative system to undercut the potentiality for the kind of corruption you mentioned has been absent because so many members of Congress are just doing the bidding of the president. So it's highly problematic. There are some signs of life. Resistance isn't futile, but we all share the worry you raised.
All right, we have time for one last question. Whoever it is, please make it brief.
Thanks so much. We'll take the next question from Joseph Bauer.
The question, simple. when you mention game theory, I could only think that the reputation of our president, and you've just pointed out how he dominates our government, is very much to use uncertainty, to use threats, to back off. That works in real estate some of the time. It seems to me as a nation, it's a disaster because we work in Bob Hormats would say, we trade in an open system. People can change their behavior. You can't just threaten. And so I'm very worried about the macro consequences. And I think you've been delicate in describing them.
Anybody want to reply to that?
I've got to
In less
jump off.
delicate terms.
I've got to jump off. So let me quickly say, yeah, if I've been delicate, I shouldn't have been. So I take your point.
Carmen, Peter.
Let me say I studied under Guillermo Calvo, who wrote at length about time inconsistency. That is policies getting reversed and announcing one thing, then it becomes another, then the time inconsistency problem is one that the effects, I hate to sound like a broken record, but the risks are all stacked on the downside. Consistent policy allows for better planning, allows for higher stability in investment other than, of course, AI. We know we've already discussed that today, but in other sectors of the economy, the old rules in which uncertainty is the enemy of investment and the ad hoc nature over time, the time inconsistency problem is deleterious for growth.
Peter, we are
Nothing
1
good.
minute over, but if you got one,
No.
okay. All right. Well, thank you so much for everyone for your great questions. Really appreciate it. And thank you, of course, most of all to our panel, Peter, Carmen, and Jared, who I think has already hopped off. Great speaking with you all today.
Thank you so much, Catherine.
Thank you. Thank you. And thank you for the organizers.